Understanding Kappa, the sensitivity of options to volatility. Introduction. The world of options trading is complex, filled with various metrics and analyses that help traders make informed decisions. Among these metrics are the Greek risk measures, which include Kappa, also known as Vega. Kappa is a crucial indicator that helps traders understand how sensitive an options price is to changes in the volatility of the underlying asset. In this article, we delve deep into Kappa, what it signifies, how it works, and its role within the broader context of options trading. What is Kappa? Kappa, or Vega, measures an option contract's price sensitivity to changes in the implied volatility of the underlying asset. Implied volatility reflects traders' expectations of future volatility, considering recent price movements, historical trends, and market sentiment. By using Kappa, traders can determine how much the price of an option might change based on a 1% change in the implied volatility of its underlying asset. Key takeaways. Definition: Kappa is the measurement of an option contract's sensitivity to volatility changes. Risk measure: it is one of the four primary Greek risk measures, alongside theta, gamma, and delta. Price sensitivity: it quantifies the price change of an option in response to shifts in implied volatility. The role of Kappa in options trading. The pricing of options contracts is influenced by multiple factors, including time decay, changes in the underlying security's price, and notably, changes in implied volatility. The Greek metrics, Kappa, theta, delta, and gamma, offer traders valuable insights into these dynamics. Calculation of Kappa. Kappa measures the price change for each percentage point change in implied volatility. For instance, if an option has a Kappa of 0.2, this means that if the implied volatility increases by 1%, the option's price is expected to rise by 0.2 units. Factors influencing Kappa. 1. Expiration date. Kappa tends to be higher the further away an option's expiration date is. As the expiration date approaches, Kappa falls due to a decrease in time value, making the option's price more sensitive to underlying asset volatility. 2. Implied versus actual volatility. Kappa is based on implied volatility, a forward-looking measure derived from current market prices. This can vary significantly from realized future volatility, thus affecting trading strategies. Understanding the other Greek measures. Kappa does not exist in isolation, it works in tandem with other Greek metrics. Delta measures how much an option's price is expected to change for a $1 change in the underlying asset. It indicates directional risk. Gamma represents the rate of change of delta, shedding light on how delta will respond as the underlying asset's price changes. Theta measures the time decay of options, indicating how much the value of the option decreases as it approaches expiration. Understanding these metrics in conjunction with Kappa provides traders a comprehensive risk assessment and management strategy. Practical applications of Kappa. Traders utilize Kappa for several key strategies. Hedging. By establishing neutral positions, traders can hedge against volatility. This is crucial during periods of high market uncertainty when implied volatility spikes. Portfolio analysis. Kappa can be calculated for individual options and across an entire options portfolio, referred to as net Kappa. This holistic view helps traders understand overall exposure to volatility risk. Market positioning. Traders can adjust their strategies based on changes in Kappa. For instance, if Kappa is high, it may signal a conducive environment for volatility trading strategies, such as straddles or strangles. Conclusion. In summary, Kappa, or Vega, is an essential measure in the options trading landscape, offering insights into how an options price responds to shifts in implied volatility. Understanding Kappa, alongside other Greek measures, equips traders with the tools necessary to gauge their risk exposure effectively and devise strategies that optimize potential gains while minimizing risks associated with volatility changes. Whether you are an experienced trader or new to options, mastering Kappa is crucial for navigating this complex financial instrument landscape successfully.